double-digit inflation has now become a reality. The last time that happened was 40 years ago. And the worst is yet to come. With the energy price cap lifting again, inflation will probably exceed 12 or 13% in October. If we look at the detail of the report, core inflation is now above 6%. The data seem to suggest price pressures are now broad-based. Goods inflation is up, services inflation is continuing to accelerate, and that's also important because it's the stickier part of inflation. So even when energy price and core base effects eventually wash out, there's a risk that inflation will settle well above the 2% target. And this poses a real challenge for the Bank of England in an environment where forward-looking indicators suggest a sharp slowdown in growth in the months ahead as the cost of living crisis intensifies. I mean, in our view, we think the bank now has to do 50 basis points at its next meeting. The recent data has come in slightly better than expected, especially if you take into account something like the PMI surveys. And so there's a narrow window to deliver rate hikes until it then gets more difficult as the winter months follow through and the cost of living crisis intensifies a bit more.
Shaan, in terms of core inflation, that also surpassed expectation, coming in at 6.2% versus 5.9% expected at the last Bank of England meeting. My colleague Jemana was speaking to Andrew Bailey and asked him about what would constitute the data coming in such that they would have to act more forcefully. Do you think that this data is enough to get them to act, quote, more forcefully at their next meeting?
I think the term more forcefully maybe has to be treated with a bit of caution, given they did 50 basis points already at the last meeting. I think this then justifies another 50 basis point hike at the next meeting. Core inflation is still accelerating, as you say. The services part of inflation is accelerating still, and that is the stickier part. And so I think 50 basis points is justified. But on the other hand, given the weakness in the labour market data that we saw yesterday, and also the looming clouds on the economic outlook, it feels like 75 basis points might be a bit too much at this point in time.
I'll ask you about some of the components here. I'm just reading through the report, and it doesn't feel like there's a lot of discretionary spend here that can be targeted by central bank action. I mean, for instance, we have seen increases in recording media. Hard to see that one changing. Package holidays definitely, and toys, perhaps games. That's still where you're seeing heat in prices. Pet food is one area that it's not going to change either. So as we see tighter policy here, some of the demand may come out of this, but it's still going to be elevated elsewhere, isn't it, around rents and what we're seeing around food and fuel?
Yeah, I'd agree with that. I think the Bank of England is in a very tough spot because a large part of the inflation that we're seeing at the moment is supply side driven. And we know the Bank of England and even fiscal policy is our demand side tools, which only have the ability to dampen the demand side of the equation. So it is a tough spot. In one sense, you've just got to wait for these effects to eventually wash through. And that's part of the approach the bank will be taking is, hey, when the base effects then unwind, what are we left with? And that's why you've got to focus on the core part of inflation, the services part of inflation linked to the labour market, linked to wage inflation, to understand what's going to happen further down the line. And I guess the question really isn't whether inflation is going to peak. We know it will peak, most likely in October. It's more where inflation settles in, say, the beginning or the middle part of 2023. And with services and core inflation tracking at around 6% now, it does look like inflation is going to be well above target for an extended period of time.